Good afternoon. I've just met up with an investor. We've got a deal going on over in Oswestry in Shropshire. We bought it for £115,000 and it's a commercial unit, so we didn't need to pay stamp duty on that because it's below the threshold. But that deal hasn't gone 100% according to plan. We managed to get planning for one retail unit and 3 apartments. And it was through permitted development. We didn't need to go through the full planning process because it was part of Class MA, which is you can use permitted development rather than going through full planning. So we managed to get that through fairly quickly. We did go for a HMO originally, but that got some bad feedback, so we just couldn't be bothered with the hassle for the size of the deal. So we got 3 apartments out of it, 3 1-beds and a retail unit, and the people we sold it from lease back the front of the building. They pay £6,000 a year to us for that, and the remaining of the building, that's what's going to be converted into 3 1-bed apartments. Anyway, I met up with that guy just, and saying, what do you want to do with this thing? Because we could either sell it on the market, sell it through an auction, now it's got planning, or we could do the development. And I've had terms from a couple of lenders. They're prepared to lend us the whole development on that. There's currently no mortgage on it. He put all the cash in, and he said he didn't need a charge, providing he's got a shareholding of the company, which he has. It's like a joint venture, so he didn't need the charge on the building. He could have it for added security, but if we want to borrow against it now, obviously he'd need to relinquish that anyway, so he said don't worry about it. So we've been offered full development funding for that, 100%, at around 1.1% per month. It's not the cheapest out there, I don't think, but they're fairly flexible, they're quite good. We've used them before. And the conversation sort of went, which way do you want to go with it? Because originally we were just going to get planned and sell it, but we've had some feedback from the agents out there, and it's probably best to actually do the development. Best numbers wise, we'd make more money if we did the development, but it's like the dynamics of our relationship. Is it better to just sell the thing, get our money back, split the profits and go again? That's more my personality, and having spoken to Baggy Just, the investor who put the money in, is of a similar feeling. Let's just get rid of it. We bought it for 115. We're probably going to be able to sell that thing for, as it is with planning, probably 160, I'd say. And it's been less than 12 months, so that'll be, nothing spectacular, but we'll make some money out of it. 45 grand. We split that both ways. We'll probably give him a little bit more than 50%, to be honest, because obviously it's all his funding. We want him to come back. He's a good guy, so we'll probably look at a 60-40 split in his favour on that one. So yeah, just a note to say, not everything goes to plan all the time. If we'd have got the HMO through planning, we could have probably sold it for more money, but you don't get everything you want in life, do you? And unfortunately we didn't get that. But rule number 1, as they say, don't lose money. And when you buy buildings for cheap in the first place, it's very difficult to lose money. You make money when you buy, as they say, not when you sell. That's just when it's realised. That's going to be proven here. We managed to get that for about 55 quid a square foot, and we're going to sell it for probably 20% more than that, 25% more than that. So yeah, you make your money when you buy, not when you sell. And in the meantime, we've been getting rent anyway. We've been getting that 500 quid a month, 6 grand a year from them, which is obviously paid for a few fees, planning fees and whatnot, which is very useful. So these are the things you have to think about when you get into these deals. Always have your bases covered, buy well, have secondary exits. If you can't flip it, can you develop it? If you were going to develop it and you can't get funding, for example, or situations change with the investors, can you flip it, make a quick buck on it? Second exits, third exits, they're quite an important part of this game. You can't just be having one sole strategy on something, because the economy might change, relationships might change, anything could happen. So you need more than one. I know people who just they hold everything, which is great, you know, in the long term that's probably a very wise strategy. We don't do that, but you know, if that's all you ever do and you're quite rigid in that, then sometimes you can find yourself in a bit of a pickle if you haven't, if you've got no liquid capital. If you need to pay bills and whatever else, and you've spent it all by keep buying property, then that can cause you a pickle. So I'm going to share with you how we work with investors, predominantly, and it's only an overview, two ways: debt and JV or equity, profit share. I'm using the words interchangeably in this sense, okay? So we'll start with debt. It's very simple. We borrow money for a fixed rate return. Now, current rates, we're looking between 8 and 12% at the moment. Again, this is only my experience. You might be able to get cheaper debt than that. You might have to go and pay more. We've just paid back an 18% loan from an investor. We've also paid back, pre-COVID, we were borrowing at 6%. But because interest rates have gone up, we're looking between 8 and 12% at the moment. Sometimes with our debt investors, they ask for security. So that may be a first charge. Now, with a first charge, what that means is that on land registry, the lender who lends you this money will have a charge against the property, which is essentially security. So if you don't pay back that loan, as and when you said you were going to pay that back, let's say that's a 12-month term, if you don't pay that back on month 12, they can repossess the property, take the property back, sell it, pay themselves, and they get their money back. Now, sometimes these investors, they don't have that much money. So if you're buying a property for 100 grand and they only have 20, then a first charge might be too much security for what they're actually providing. So sometimes you can give them a second charge. Now, the only reason you'd need to give a lender a second charge is if there is already a first charge holder. So if you have a property that's worth 100 grand and you're buying it for 100 grand and the first charge lender has an £80,000 loan, then the second charge lender here may have the £20,000 loan. That would mean you bought the property for 100, you've got no money in it of your own. The first charge lender is 80,000, the second charge lender is 20,000. Very simple, don't need to overcomplicate it. When we say debt, we are borrowing money for a fixed rate of return. Now, when we move over here, we'll use the term joint venture and profit share for the sake of this video. So when I say joint venture, what we do is we usually do a 50-50 split with our partners. That's a 50% profit share split. Okay, so generally, again, they put in 100% of the funding for a 50% profit share. So if we use the 100 grand again down here, they'd put in a full £100,000, and let's say we sell that property for £140,000. We had a good deal on it. Remove all the stamp duty and legals for the simplicity of the numbers. We'd then make a 40 grand profit, and we'd make £20,000 each. because we'd split that 40k based on a 50-50 split. Now, what I tend to find here is that you build good quality relationships with your joint venture partners. Over time, these guys just keep coming back. When they see that you're basically making them £20,000, £20,000, £20,000 using this example here, they keep saying, come on, let's do more, let's do more. Do you make as much money doing this as you do here? Not necessarily, no, because you're giving away 50% of your profit rather than just paying between 8 and 12%. But the reality is, where are you on your path? If you're just starting out, perhaps you don't have any money at all, but you do have a little bit of experience, then potentially you could go into a joint venture partnership with somebody who's prepared to put all of the money in. And they might say to you, well, you're not putting any money in, you've got a little bit of experience, I want 60% of the profit and you can have 40%. Now you have to make that call at that point. These are very fluid, very flexible, they're not fixed. We generally go 50-50, especially with new partners, because our experience and knowledge is very good. We've also gone up to 80% profit for ourselves, with 20% for our partner, because they only put in 50% of the money and we had to raise the rest elsewhere. So these things are what we do. We create a document called the heads of terms. We put down on a heads of terms what we've agreed face to face, and then we put it into a legal contract, blah, 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 get all the legals done, and then we do the deal. With these, generally speaking, we'll set up a new company. So we set up a company per deal. Generally, again, it's very difficult to say black and white because these things are quite grey. But what we will do is we'll set up an SPV, which is a special purpose vehicle. It's essentially a limited company for a specific thing. So we'll set up an SPV, and if we'll keep it simple, 50-50, the investor will have a 50% shareholding. I will have 50%, my holding company will have 50% shareholding. We'll then sell the deal. Let's say we make 100 grand profit, and then it will be distributed 50%, 50%, whatever the shareholders agreement is at the beginning. I like to be in and out of deals, and one of the big reasons for that is because when you work with joint venture partners, it's very I find it very clean. You can get in, you can get out. The profits that you make, you can then even put into long-term assets by good quality commercial. This is what I do, good quality commercial, industrial, retail units, offices, blah, 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 with long 5, 10 year, 15 year leases on them. So I invest profits I get from trading, then I put it into long-term holding stuff. Debt investors also, if you look here, you get bridging loans, you get mortgage lenders, but I'm talking about private investors here. But essentially what you're doing is you're borrowing debt, similar to bridging, really hard money, where you're paying a higher interest rate than you'll be getting on a mortgage lender. But it's in essence, it's the same thing. You're just working with an individual rather than a company. And yeah, there's not much more to it really. No need to overcomplicate it. I'm going to run through an example now. So I use the same figures across the two to make it clear, right? So if we're borrowing money, we'll borrow it at 10% fixed for 12 months. Roll it up so it's paid back at the end of the term, okay? And we'll go for a £200,000 value, £140,000 purchase. They do exist, that's a 30% discount. They're out there, you've just got to go looking and working with motivated sellers on them. Again, please keep in mind, I'm not putting stamp duty and I'm not putting legals and all that stuff on here, so please keep that in mind. So we borrowed here £140,000 to purchase this property. You know that you can get you've got a good deal. You know you could sell it in auction. You could give it the new buyer a discount to get that thing sold. So what we'll do is we'll give the buyer a 10% discount. So we're going to go for 180k sale, which gives us a gross profit here of £40,000. Now, you're paying 10% on a £140,000 loan. So that means you're paying 14k on top of the 140. So you have to pay back £154,000 on month 12. So let's say that this loan goes all the way to term, 12 months, and you pay it back on the dot. You're going to be paying £14,000 on top of your 140,000, mean 154,000. From your profit of 40 grand there, you need to take off another 14 grand, which means you walk away with £26,000 net profit from a deal you put no money in. However, if you've chucked that into auction, if this is your strategy, or if you did a like refurb and sold it on the open market, and it only took you, let's say, 6 months to sell the property, then you wouldn't need the loan for 12 months, would you? Which we've took the loan out for. Let's say you only needed it for 6 months. These loans I do on a pro rata basis, meaning if I only need it for 4 months, I only pay 4 months worth of interest. If I need it for 6, I pay 6, 9, yada yada. So if I'm only using this for, instead of 12 months, we're going for 6 months. Instead of paying £14,000 interest on the 140k loan, we're only paying 7k interest. So instead of making £26,000, we're actually making £33,000 net profit, because we're only using the money for 6 months, meaning we only need to pay £7,000 worth of interest, which means we only have to pay £147,000 back to the investor on month 6, meaning we make £33,000 gross profit on an asset that we put no money into. Completely doable. You need to get out there, networking, putting deals together and learning. Don't worry so much about profit if you're just starting out. Of course, you need to pay the bills. Learn, build your network, get as good at this stuff as you possibly can. Far more value than the money that you bring in. That follows knowledge, wisdom, who you hang around with. So that's debt. This one, JV, equity, profit share. We'll use exactly the same figures and we'll do a 50-50 split, as I mentioned previous. Okay, so we're going for £200,000 value, 140,000 purchase. Exactly the same figures, sold it for 180, 40 grand gross, divided by 2, that's the 50-50 split. So you both walk away with £20,000 on your money. How much money you put in? 0. They've put 140k in plus fees and blah, 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 blah. You split your profit. You walk away with £20,000 each. 20 grand created from your head, from the value you brought to the marketplace and to your investor. Now, the more of these you do, the more, in my opinion, that you can demand a higher percentage, because you're the one doing all the work. They're simply the money people. Now, this is a bit of a mindset shift, because people think that money is the all important thing in this scenario. It isn't. The biggest thing in this scenario is getting the deal, pulling it in, working with the legal team to make sure it's pulled together quickly, working with the auction houses if you're going down that route to make sure it's guided properly. There's a lot more value in that, in my opinion, than the money, because the amount of cash in the system at the moment, well, and it's only going to get bigger, is huge. You can go to bridging lenders, as I mentioned earlier, and you only need 30, 35%, 40% rather than the whole lot. So in my opinion, if you're joint venturing, the better you get, the better your profit share can be. But if you're starting out and somebody comes in and says, yep, I'll write the check on all these things, but you're only allowed 20%, we only want you to take 20%, we want 80%, you've got to make a commercial decision on that point. The more deals you do, the more experience you get, the more knowledge you get, the more success that you get, and the more failures you take, giving you the experience, the more you can start dictating terms, you know. We've got an investor who started out at 50-50 and now he's down to 30-70, he takes 30%, we take 70%. purely because we were saying, you know, we're doing all the work here, all you're doing is being the capital guy, which is, yeah, it holds a lot of value. But the reality is we could go elsewhere for that money now. So in order for him to, you know, stay in business with us, he needs to take a lower share, profit share. That's just the way, you know, just the way it is. It's a business commercial decision that we've made. With regards to debt, I do need to tell you to be careful with anti-money laundering. Use third-party plugins like Credas, C-R-E-D-A-S, that's who we use. You are meant to do AML checks on investors. You know, there's a lot of people years ago who, you know, cleaned up dirty money through property and whatever. So you do have to do that, make sure everything's legitimate. With regards to the joint ventures and stuff, very often solicitors will do that. Because we do company structures and all this stuff, solicitors and accountants do a lot of all the anti-money laundering stuff. Whereas very often we do loan agreements, we don't use solicitors, sometimes we just do it ourselves. So if we do that, we do need to do AML stuff. Any questions or anything on all this, just drop a comment below or drop me an email or something and I'll go through it. That's a very basic overview. You can go very in depth on each one, but just if you don't know this stuff, this is more than enough to just get out there, get in the game and figure it out as you go. I hope that helped.